I'm Colby McFadden, and for the last 2 decades, I've worked with some incredible families and individuals, helping them manage their investments and finances. I'm a father of 2 daughters and recently a grandfather of 2 granddaughters, and it really got me thinking about what resources are there for women to find a trusted, reliable source for investing and savings. So I reached out to Kristen Yoder, a good friend for years and somebody I've really appreciated their ability to call out BS. And I asked her if she'd like to work on a project where we could create a trusted resource where women could turn to learn about savings and investing.
Hi, I'm Kristen Yoder. I'm a 16-year Los Angeles cannabis industry veteran and host of the Cannabis Detector podcast. My co-host and I have collaborated on a series of episodes focused on investing in cannabis in the past. So when he approached me about doing a podcast focused on helping women build confidence in their money management skills, I jumped at the opportunity. Welcome back to the Confidant Investor. Man, it has been a freaking week for crypto. My first foray into investing is, thank God. I kind of invested more after the last time, but only to expand my portfolio. But only $300. But I bought some. I only spent 45 on Bitcoin, which was stupid because it lost like half of its value. Buy the dip, but I did not do that. And then I bought some of the old ETC Ethereum coin before they hit a hard fork, whatever that means. And some of the ADA Cardano, because the dude is a good dude. And but anyways,
been out there in the news. Sure.
Yeah, it all ate shit. So out of a $300 investment, I've lost like $100. But dude, from what I'm reading and from everything, it's a long game. Thank God, it was only 300. It's just enough to pique my interest, but not enough to hurt my soul by any means.
Sure.
This is a good segue into today's episode, which is, I'll let you take it from here.
Well, if anybody missed last episode, they definitely should go back and listen or watch it, because it was great, because we had talked about the little hangover from Saturday Night Live and, little hair of the Doge and
hair of the Doge.
We also talked about this euphoria that's going on around now at this particular moment. And so now you're seeing the tail end of what happens in these parabolic moves. Because this is why for years it's been known that quote unquote retail investors are usually late to the game. And one of the things that professionals, what they watch is they watch the order flow, and there's a way that you can tell what orders are from institutions and what orders are from individuals. It's, a size matters situation. And so when you start to see that the institutions are selling and the retail people are buying, and that has been the case recently, then there's this transition happening. And the institutional guys, the professionals, they got to do this for a living. So they're always going to be early. They're going to be early to the game. They're going to arrive early. They're probably going to leave early. What's happening right now is you have a lot of people that are like, oh, hey, I don't want to miss out. And we talked about that in the last episode. The thing of FOMO is so palatable. People don't want to miss out. So you're doing it the right way because you're looking at it long term. Because I think it was in episode 2 or 3, we talked about the difference between investing and speculating. Definitely. Now you're seeing in real time, right? You're experiencing in real time what speculating is.
And also, and I always talk about Reddit, but it's like, I think the GME thing was like the retail investors were fucking the hedge funds just for a minute there. They got him, dude. And it was like, it felt so, I wasn't a part of it, but it felt so good to be like, oh, dude, they got, was it Marvin Capital or whoever? Totally screwed them. And it's like, that's the other thing I find so interesting is there are these shorts going on, and retail investors, they're learning that maybe we can fuck these big guys. And
Yeah.
it's like, they're not even investing for the money, they're investing to fuck the big guys. And I kind of like that, but I don't have the money to invest to fuck the big guys.
Yeah. I love it. I love it. But I learned a long time ago that when the big boys are in the ring duking it out, stand aside and watch the show.
Yeah. So, and I sent you a thing because they're like, yeah, but you know, they're short, they're gonna have to pay up anyways. You might as well buy now. And I'm like, wait, is this true? But what did you say?
Well, you know, people forget that for over 20 years, Wall Street has been hiring some of the smartest minds straight out of MIT and a lot of other smart places to build algorithms and to build
Quants.
black boxes. Yeah, quants. And they've been trading and because the whole thing about Wall Street, the reason there's a futures market in Chicago and the cash market in New York is because in the old days, how you tried to make money is information traveled very slowly between the two places. So there's usually a spread in price that you could manipulate. Now with technology, that's closed. That doesn't exist anymore. So the technologists built these algorithms. So if people think that Wall Street can't build the same thing around cryptocurrencies, or if they can't build the same thing around these chat rooms that are anonymous, and because I read a lot of these things and I know normal, average, everyday people and how they post things, you know, it's pretty much third grade level or below. And a lot of these things I read on Reddit are, you know, are written by very smart people way above the level of just the average Joe trader. So I just think, I think if people are not understanding that Wall Street's been in this game and the quote unquote pump and dump longer than anybody else, and they've been doing technology around it better than anybody else for a long time, don't think you guys might not be on a little bit of a ride.
There's definitely manipulation with YouTube influencers. And I mean, some of the people have talked about it, that they were reached out to and offered a ton of money to make a post to influence the retail investors, the apes, as they call them. And it's all, I mean, it's similar to cannabis in that sense. And I guess that's what, like, that's why we're talking is like, I have this bullshit detector for cannabis, and also as a woman, an inherently good due diligence, long-term practical thinker. And it's learning how to apply these skills to the financial market and realizing it's not that different when it comes to bullshit and manipulation. It's very similar. So yeah, I mean, it's where I'm getting caught up is I downloaded Webull, and my God, it's so much information. Like I couldn't even buy stock if I wanted to because I don't even know how to do it, because it's like, buy it at this price or this price, and there's all these numbers and stuff, and I was like, what am I even looking at? Like,
I would say Webull has got way more than most novice or beginning people would need to have in an app.
So it feels like the next step is learning technical analysis and also market trends. You have a chart, you have some graphics.
So I think what, you know, the most important thing, and this is kind of like everything in life, is that we're always going to have distractions. There's always going to be a shiny object, and depending upon who we are and how our personality is, some people get distracted by the shiny objects more than others. And what I've found is that what you have to do as an investor is you have to look at all the shiny objects. You have to be interested in them. You have to learn from them. However, you have to have some fundamental rules that you run your money by. You have just some fundamental concepts that we know have stood the test of time, because that becomes a screen that you can use to make decisions. And when you see a shiny object, you say, okay, hey, can I make that shiny object fit within my overall plan and strategy that I'm doing? So I've got some visuals, and I'll share a few things with some people. And as I'm doing it, you know, feel free to.
Okay, so I was doing research for social media for the podcast and looking up quotes, and I I found some interesting quotes that I think are really relevant to what we're talking about now. Like just real quick, where is it? You never know, you would pick this one. You never know who is swimming naked until the tide goes out.
Sure.
Yeah, I definitely feel like there's so many naked people swimming right now. You know?
Well, the tide's high, right? And that was a quote Warren Buffett had said in 09-ish time frame, when the tide had gone out in markets and Madoff got exposed, and not only him, but there was a lot of scammers that got exposed at that time. And that's what he was referencing, is that when times are good and there's a lot of liquidity and everybody's chasing risk, you never know who's legitimately telling you the truth and who's just, you know, putting up a big storyline. And when you find out is when there's a tide, when the tide pulls back out, or what we have a liquidity event. And you'll see that very soon in the near future.
I feel like we're going through, we're at the start of one.
And we are, the sell-off in Bitcoin that you're seeing, you know, what happens is once an asset, when everybody builds these algorithms, they have these historical norms or parameters they put around, and they go, hey, we're going to make money if we stay within those norms. And the moment that they swing outside of the norms, then the losses become really extreme. And so they're out very fast because they have to be, because they're usually leveraged and margined up. So once you go outside of the historical norms and volatility, you get a liquidity event. And in some cases, it causes some guys with great losses. They have to sell. The old adage is, if you can't sell what you want, you sell what you can. So a money manager, if he's getting margin calls and the stuff that's eating dog crap is too low in price, he might have to sell something that's good that he wanted to hold, but he needs to make the margin call. You know, he needs to pony up cash. Yeah. So when you get into liquidity events, you could the beginning of it could be a sell-off in Bitcoin, but it can travel through the rest of the market, because as one money manager eats shit in one area of his portfolio, he may get forced in selling other areas to pony up money. And that happens in every.
I feel like it's happening. I mean, I'm not paying attention to the entire market, but even the stocks that I was paper trading, everything is going down right now.
Yeah.
So I don't know if something's happening, but
I'm assuming you can see the screen, right? You have
yes.
All right, perfect. Well, so this is something that came to me back in 08, in the last, when we had a crisis. Todd Harrison, who you may know also in the cannabis space and plant medicine, Todd was running a great website called Minionville, and this was one thing that he shared a lot during that time frame. And I've used it ever since. So a little hat tip to Todd, because this has been a useful tool for people to visualize when things are riskiest, and because it's very counterintuitive. In the last 5-6 weeks, as this euphoria has hit and everybody is talking to their next door neighbor and their cousin and being told about how much money they're making, they're all jumping in, just like you experienced with somebody saying to you, oh, hey, yeah, Elon's going to be on Saturday Night Live and do with it what you will. Everybody gives you that precursor, right? Oh, do with it what you will. I don't want to be giving you advice, right? So you've had this whole euphoria. And as you can tell by this cycle, this denial panic continuum, it happens in all kinds of time frames. In a big full market cycle, like the last low in the stock market for like secular big low was 08, 09. And so you can have this cycle go over 10 or 15 or 20 years to when we reach the next euphoria top. Some people are arguing we're there now or very shortly, right? And then you go through a period of anxiety and denial, because people who are late to the game, when they take that first 10, 20, 30% hit, they go, oh, it's going to come back. It's going to bounce back. And they start doubling down or buying down. And then all of a sudden you get into these liquidity events. And as it starts to break down, those people who are late to the game, let's say they started to get involved when the thrill was happening, or worse, they got involved at the peak of the euphoria and they didn't know it at the time. The fear and desperation comes in really quick. When you put $1,000 to work, and a week or two later, you open it up and it's $600 or it's $500. Trust me, there's a lot of people who took their $1,400 stimulus check and they're now looking at it being $700 because they did exactly what you're experiencing.
Yeah.
They're reaching the point of fear and desperation, because how many of those people were saying, hey, I'm going to turn that 1,400 into 2,800 and pay some back rent, right? And now they're super screwed because they don't even have the 1,400 to begin with. So you get into these panic capitulation things very quickly when you have a lot of retail people new to the game. So if your intuition is very good in feeling and sniffing out what you're hearing and feeling. Maximum opportunity, the whole thing in investing, buy low, sell high. The counterintuitive part of that is when prices are low, do you know what the news is like? It's shitty,
it's
right?
bad.
Nobody wanted to buy the cannabis sector a year ago, right? It had been, the whole sector was down 30, 40, 50%. And, right at the moment of like, nobody wanted to touch it or be anywhere, it had a great, incredible rally. And you'll see this across markets and sectors. So it's just really important that when you feel that FOMO, that fear of missing out, chances are you're up here at euphoria. The time that you want to get greedy, and there's a long-term phrase from Sir John Temple that said, when other people are greedy, you should be fearful. And when others are fearful, you should be greedy. Well, the other is, hey, when there's blood on the streets, buy. So the next time, like, you don't want to deploy any more capital until people are crying and everybody's saying crypto is shit and that's crap and I'm never going to buy that crap ever again. That's when you become more interested in adding capital.
I mean, that's what happened with Bitcoin. It like hit 20,000 and everyone's like, oh my God, I lost the keys to my wallet. And like, holy shit, man, I could have made millions. And like, oh, I bought like drugs with my Bitcoin and it was worth so much. And then it tanked and like went hell low. And then it got to like what, like $55,000. And now it's like down to like 35,000 in a day. Like, holy shit. So I feel like we're in the anxiety denial part and like heading into the fear, because I see mad denial with retail investors in crypto, because they're like, buy on the dip. But I feel like it's going to keep going.
Well, it's when the first dip gets bought and then it doesn't go make a new all-time high, it fails and then falls back below that point where everybody first bought the dip. That's when you'll go into fear and desperation. The anxiety and denial happens because the first decline usually gets bought and the asset rallies for a little while and gets everybody emboldened. See, I told you it was just temporary. And then if it rolls over and starts to break those old levels, this is where technical analysis comes in so handy in managing risk. And we'll do this in another episode, but utilizing charts and drawing lines on the charts and utilizing what we call stop losses is a really great art and science to manage risk. But for this, remember this though, on this, the most important thing is markets are driven by people. A person can be smart, but people in groups, not so much. So just remember, herd mentality is whatever the herd is doing, you want to start to do the opposite.
Yeah, I mean, if last year with panic buying toilet paper and this year with people putting gasoline in fucking plastic bags wasn't a lesson for you, like, I don't know what is, dude. But let's take a break and come back.
Yeah, because the next slide is really helpful in helping people build it out.
Okay, perfect. Okay. What is the next slide about?
All right. So, now that we've kind of covered the, how to have the herd help you, do the opposite of the herd. And it's really hard to do because, we're mammals and we got soft, furry fur in skin for a reason. We like to group together and we like to be part of the group. So that's what drives these animal spirits that we always have to be aware of. And so, just understand the weaknesses that we have as humans and lean into them and learn from them. And one of the best,
it's like behavioral economics, essentially.
Exactly.
There's a guy, Daniel Pink. He is one of my favorites. And like they did a study where they had people go in an elevator and they would have just one guy just like looking up or turned backwards. And all of a sudden, like people would like turn backwards. The more people that were turning backwards, like people had no fucking clue why they were doing it. They just did it because everyone else did. And it's like what we do as people.
Yeah, I mean, the hoarding is a perfect example. Is when people don't know what to do, they'll follow others. And then once that first person starts taking things, and that triggers in our mind a scarcity mentality, that boy, it just goes from there. And scarcity runs in a lot: love, money, toilet paper, gasoline. It goes in a lot of ways. So it really affects our money life a lot. And so what you do to kind of remove some of those emotional triggers is you go back to just these fundamentals of, hey, in the structure of things, if I build a house on a solid foundation, then I'm probably going to be able to weather most storms. And so what you have to do is, if you're going to build a portfolio and you want to maximize your returns and you're trying to increase your wealth, because realize, if you're trying to increase your wealth and get rich, concentration is the way you go about it, but that adds risk. Once you're rich and you already have money, usually concentration is the death knell, because once you already have money, you're trying to keep it. And so diversification becomes the story. So right now we're going to focus on people who say, hey, listen, I'm trying to build a portfolio for growth. How do I do it so I can maximize all the possibilities into probabilities? How do I hedge as many of my bets so I can reduce my risks? And the first thing that you do is you think of investing like a rising tide. You want to pick the sector or the market that's getting the most attention and the most momentum. For the last 10 or 12 years, it's been technology. In the future, it may be totally different. So you have to understand the strongest sector is going to be affected by what's going on in the economy, and then also what's going on in other aspects. So in the future, technology may not be the strongest sector. We may see commodities be a strongest sector if inflation stays in the headlines for a while. So realize the analysis is, the investor is first to stop and say, hey, from what we call relative strength, compared to all the other places that I could put money, what is the sector that's seeing the greatest amount of strength? And then from there, you then say, okay, what are some exchange traded funds that reflect that sector? Because if you can find an exchange traded fund, you can then easily find what holdings are inside the exchange traded fund. And one of the things you want to do is you want to invest alongside the money managers, especially if you're getting into a nascent industry like plant-based medicines or ESG or alternative energy. You have to think about it that, hey, if I'm going into those areas, I want to be in the names that I know the mutual fund managers are going to buy when they have to incorporate that sector into their portfolio. Yeah. So always think about what are the big boys doing, and that's what you want to start to build the portfolio around. Okay. So, it's identifying that, and then you focus on the strong sectors. And then you start to build the portfolio from the perspective of both long-term, intermediate term, and short-term timeframes. And we talked about that, I think, in episode 3, is determining your time frame. And some of your money should be allocated some long-term, like, hey, I'm looking 10 years out. This is towards retirement or later. And some money may be a year. I'm trying to achieve something in a year or 2 years. It's really hard to manage risk or achieve things in short time frames, because anything that happens tomorrow, the next day is anybody's game.
Yeah.
If you want to be a day trader, there's techniques to that, and this is not it. So if you're somebody listening to this going, yeah, but my time frame is really short, okay, then you need to go take some courses on day trading and realize 90% of day traders lose. I've known a lot of day traders, and I only know a handful that make a living at it.
Yeah, I mean, that's because they react, right? It's a reactionary thing. Or they have the technology and the technical analysis and the education and math and all of that to be able to do it. But yeah, aren't the best investments are usually the index funds that don't get fucked with. They're like 1%. Yeah, like 1% of managers beat the market.
Index. Yeah. And that what they call alpha is if you're trying to beat an index, trying to beat the market, you're trying to get more alpha than that market. So let's talk about how to do that. Like how you can structure or build the portfolio and give everybody an idea of that. But before I do that, any questions kind of around that or anything that, you know, is first top of mind for you?
I mean, the only thing I was thinking when you brought up technology is the importance of politics, because right now we have like Apple facing the issue that is continuing, not new, about using prison labor from China, and then we have like the Democrats being really harsh on everything. So it's like,
Yeah.
you know, even the strongest sector, it's just hard to know, because every day there is news coming out that is going to have a reaction, a market reaction, I would assume.
Yeah, yeah, and that's why in this identify, I have in parentheses past and future,
Yeah.
because you do have to do a little analysis of the environment. Like for instance, technology, it may have some headwinds on it, you know, because, you know, history has shown that whatever was the greatest or biggest industry eventually gets broken up by the government, especially if you go into tough times and they need tax dollars. So don't forget, Ma Bell was broken up, Standard Oil was broken up. Those all things happened at market, you know, at times when we had gone through market euphoria, and then there was a breakdown, and then the government, you know,
that's literally what the IRS is doing with crypto,
Sure.
because they actually included it now on their tax forms.
Yeah.
Do you have crypto investments? So
they don't want that money out of the system. That's the biggest risk.
Yeah.
Yeah. All right, so let's kind of bring this down personal. So let's say somebody has $10,000 to invest, or $1,000. You know, it doesn't matter what the number is. Just take what we're going to talk about here and apply it to what capital somebody may have. And also realize the percentages that we're talking about are different for each person. So this is basically a general rule that I would say, hey, based on what your needs are, Kristen, that we've talked about in previous episodes, your money personality, your time frame, your risk tolerance, all these things, and what you're trying to achieve, having half of the capital thinking long term is probably a very good thing, because what you're doing there is you're creating what we call core holdings, and you're picking things that are going to benefit from that rising tide. So you're looking for things that you know have what we call a secular bull market. It looks like that market has a tailwind and a lot of attention going to it over a long period of time, 5, 10 years. Yeah. So technology has been in one of those, healthcare, you know, so there's a lot of things, and whether the overall market is bullish or bearish also matters. So, you know, you have half of it focused that way. And really what you're doing there is you're watching this quarterly on, you know, and once a year, you're really evaluating, am I in the right places? Do I need to be a little more strategic with my adjustments, right? So yeah. You're not trying to do any timing there. Yeah. And then maybe you take another 25% of the money and you do tactical allocations, or what we call swing trades. So as an example, let's say you've identified that XYZ index is one of your core holdings and you think it's going to rise over the next 5 years. Then you may want to take a little extra money and buy that when that index, when you go through these, you know, euphoric peaks and then capitulation lows. So when that index sells off, maybe you have some capital available to buy in at the low points. And then when it rallies up to a certain point on the charts, you then reduce that exposure. And so then what's happening is in your holdings, you have one that's a core long-term hold, and then you have another that you're adding and subtracting based on the waxing and weaning of that market. And that works well if you don't have any tax worries, or if you do realize if you're doing buys and sells on a regular basis, it's probably best to do that in an IRA account to do some tax deferral. But nonetheless, this strategy is a way of combining, hey, I have a long-term focus and I want to generate some extra return with some short-term moves.
So I have a question about that I'm confused about. If I sold some stock to invest in another stock, do I still have to pay tax on what I sold if I reinvested immediately instead of taking it out of the bank?
Yeah,
whatever?
that is what short-term capital gains is something everybody has to be aware of, and also what they call wash sales. So those are two things to, that everybody should have some basic understanding of before they start trading is, hey, what is short-term capital gains? What is long-term capital gains? And what is a wash sale? There's 3 simple Googles. If you have a tax person, it's a 5-minute conversation with them to ask those questions. But short-term capital gains right now is, hey, I bought something for $1. I owned it for 30 days, anything less than a year. So I bought it for $1. I sold it for $2. That dollar I made, I'm going to have to pay short-term capital gains on.
What if it's in an IRA?
If it's in an IRA, don't worry, there's no capital gains in an IRA. Everything
because you're not taking the money out of the IRA, correct?
Exactly.
You're just moving it around.
Yeah, so if you have a Roth IRA or a regular IRA, that's where you want to do more of your active trading if you happen to be at a higher tax bracket, or even if you just are trying to not pay Uncle Sam as much money as you want. And
IRAs mean you can't touch that until how old?
So if it's a traditional IRA, that's money that if you take it out of the IRA before you're 59 and a half, you're going to have income tax plus a penalty to pay. Gotcha. The rules are a little different with a Roth IRA, but nonetheless, like I said, once you start investing, it's also good to have a good tax preparer or tax person that you can always ask tax questions. Advisors oftentimes know them, but since they're not tax professionals, they're really not supposed to give tax advice.
Gotcha. That's why Webull had IRA on my account, because I'm like, why? Why does it have IRA? But that's to have your investments in. Gotcha. Okay.
Yeah. So you can open, like, that's probably like, hey, do you want to open an IRA? You can have an IRA and a regular account, and in the app you can switch views between one account and the other. So so just note that, and I would say to everybody, if you start investing, you should also make sure you have conversations with your tax person around these types of things, because it'll be really helpful.
Totally.
So if we've deployed 75% of the money, we've got 25%, and so what do we do? Because Kristen has said, hey, I got to focus on some long-term stuff. I got some intermediate term goals I want to achieve. So we bring in this tactical momentum portion. What about some of the shorter term goals? Hey, I want to try and take advantage of market trends to make some shorter term money. Okay, well, with that other portion, maybe this becomes part speculative, part trading, whatever it may be, and you end up flanking or circling around these core assets, things that are shorter term trends. And so maybe there's a little bit of money, like you're doing right now, into some crypto areas. Maybe this is your strategy and tactic money, where it's sitting in cash, and when there's an opportune sell-off in markets, you buy the dip. And then when there's a rally, you get out. And that money is more of the money that keeps you engaged day to day, and watching and looking and reading and learning. Because it's that money that you're actively moving around, possibly in shorter time frames, taking more risk.
It's like gambling. That's the gambling money, is how I feel. Like,
yeah, that is,
because it gets you stressed out and addicted to checking the app every day and really like engaged. It's like, I never thought I'd want to invest in the stock market because it stresses me out. But just having a minimal amount and playing with it is super interesting and not as stressful than putting in too much and being like, oh my God, dude, what did I do?
Yeah. Well, and that's why, a structure like this combines both investing with speculating. And then on the speculating side of it, if you want to use a gambling analogy, when I go to Vegas, there's a reason I play blackjack. And it's because I know how to play it. I know where to sit. I know if there's 2 or 3 decks that we're playing with, I can keep a pretty good eye on the cards and get a sense of the table. If some other douchebag is ruining the table, I know I can step away. So that's kind of the only game I play because I know I can manage my risks. And I know, and I only play with what I know I'm willing to lose. So this is the same thing, is in this structure on these intermediate and short-term items, you manage the risks by making sure that you're going into the sectors that have a rising tide, you know, because if you're in a bull market, if you're in a rising market, most of your mistakes, if your entry is bad, will kind of get washed away because that market's rising over time anyway. So it's really important in that the first step that we talked about, identifying the strong sectors, that's like 80% of the trick. If you get that right, the rest really kind of just falls into place.
Yeah, to have a goal of how much you're willing to lose and how much you're willing to spend. And from also what I'm reading, how much you're looking to earn. And it's like when you invest in crypto or something, if you can afford it, you don't sell low. You just hold on for the ride because you have a goal you're trying to meet, and you're not going to sell until you reach it and hope to God it doesn't just bottom out and then doesn't rise again.
And it's important that sometimes realize this too.
Yeah.
There are times you will get a surprise. So there are a lot of people, I saw a lot of guys retire, engineers, smart guys, retire with very large 401ks in 1998 and 1999 because they were making so much money trading .com stocks. And by the time 2002 hit, they were crying and they were going back to work because they had never traded in a bad market. And there's a lot of people that invested money in the year 2000 and it took them 10 years for it to come back. But to your point, hey, if you wait long enough, right? And that's why you got to make sure, that's why Wall Street always says, oh, to manage risk, you got to be a long-term investor. Well, that's Wall Street's cop out for just saying, hey, yeah, if your entry is bad and you wait 10 or 15 years and you can afford to wait that long, okay, great. But for people where time is of essence, entry really does matter.
Yeah. Good to know. Well, I think that's a good stopping point.
Yeah, and I think the next one we can talk a little more. We'll show people visuals of technical analysis and how to use that to manage the risk. I think that's a good point to go on to next.
Yeah, because I have some sectors that I'm interested in as a consumer that I think would be good to use as an example to follow along. So
we'll show everybody how to pick the sectors and then how to manage the risks of them. That'll be a good one.
Okay, perfect. So thank you everyone for joining us this week, and stay tuned. We have our YouTube channel up and our Instagram, our website, confidentinvestor.com. Everything is going up. So stay tuned for our next episode and have a great day.
Take care, everybody.
Thanks for watching episode 6 of The Confident Investor. Give us a like and make sure to subscribe. You don't want to miss the next episode. Kristen and Colby go down the rabbit hole as they discuss how using fundamental and technical analysis can be useful in managing FOMO and other distractions. You'll see how charts can be a useful tool in managing risk, and how fundamental analysis can help find the next investment wave. Visit confidentinvestor.com to watch episode 7, The Fundamental and Technical Rabbit Hole.